Yeah, hello everyone. So I'm going to talk about a very unique product that we have created just for the IFAs. So we are going to talk about how IFA can incorporate PMS in their product portfolio that they are recommending to the clients. So yeah, so there are multiple products which are out there, right? So most of the Indian investors are been investing into mutual funds, PMS and AIFs. And there are different categories of investors as well. For example, HNI investors, ultra HNI investors, then there are retail clients. For HNI investors, ultra HNI investors who have investable corpus of more than 10 CR, it's very convenient for them to invest into something like AIFs and PMS. But when it comes to the retail clients, like who have investable corpus of less than 2 crores or between 50 lakhs to 2 CR, so for them the opportunity is only into the mutual funds. Because it will be a serious concentration risk for the investors if they choose to invest into PMS or AIFs. But again, if an investor is out there who is looking to invest into PMS and AIF, so advisors should have those products there that they can recommend to the investors. So this is a typical model portfolio that advisors follow while working for a national distributor or let's say a family office. So there are different products which are out there. Typically it's allocated like equity, between equity, debt, PMS, AIF, then there are alternates as well. But there is a glaring product gap which is there in the product portfolio of a national distributor and the portfolio recommended by somebody like an IFA. So if you look at the allocation that goes between the PMS and AIF, which is a 30% allocation, that's entirely missing into the recommendation that goes out by the IFA to their clients. So again, if you look at after doing all those sort of asset allocation and advising different products to the client, if you look at the overall portfolio return, so the overall portfolio return is hardly beating the Nifty return because it's well diversified, but then there is again a component of debt. So obviously the return that HNI investor or ultra HNI investor is seeking for, it's on the lower side, and they are looking for more for the portfolio stability and lower volatility in the portfolio. But having said that, the return is hardly beating the Nifty return over the longer term. So we have found a solution for that. We have something called a core and satellite portfolio, where we have multiple schemes in-house, which is all seasons and Supervalue, that we have combined to create a portfolio for the clients, where a client can invest in a fund of fund on a PMS platform, and they can also have an exposure to a satellite portfolio, which is entirely equity portfolio. So it serves the twin purpose of having a PMS exposure plus also having a diversified, well asset located portfolio for the client. So if you look at the core portfolio that the client will be having, so it will be a 60 to 80% weightage can go to the core portfolio. It will be having 10 to 15 mutual fund schemes. All the schemes will be on the direct code. So and there will be a rebalancing that will be carried out in the core portfolio that will be through the ETFs or the index funds. So typically what we are targeting with the core portfolio is that over a long term it will be giving a Nifty plus 1% kind of return. But the satellite portfolio is the return seeking portfolio. It will be trying to give a return which will be at least 4 to 5% higher than the core portfolio return. And again it will be a 20-25 stocks, mid cap, small cap stocks that will be giving the most of the return to the investor. So if you look at typically how we are running the core portfolio, and this is typically the process followed by the institutions and the distributor, national distributor. So they have the model based allocation, which is they are trying to allocate across different categories, be it large cap, mid cap, small cap, or asset classes like equity, debt and gold through the models like Yardney model, Fed model, Buffett model and all those things. And after finding out the right asset allocation mix, the main task comes towards finding the right scheme that we can recommend to the investors. For finding out the right schemes, we have something called a 3-step manager selection process, where we are running the numbers for last 3 years to 5 years, and we are trying to find out the best performing scheme in terms of returns, finding out the portfolio schemes which have given the lower volatility, and also we are trying to look at the qualitative factors like exit load, expense ratio, all the schemes that are having. And then finally we are trying to interview the fund manager. So since we are ourselves a fund management company, so we have some view on the market. So we are also trying to interact and find out the fund manager's view and then try to onboard the scheme into the portfolio side. So this is how we create the core portfolio, which is very diversified, make up of like 10 to 15 mutual funds, and we carry out rebalancing on a frequent basis to meet the asset allocation needs for the portfolio. Now the satellite portfolio is basically your super value, which is a mid and small cap scheme that we are running. So this is a boring slide. I think we have seen it for the we have seen it multiple times. This is a category return across the large caps, mid and small caps across last 14-15 years, and we have seen that large caps and the small caps are outperforming the category. But if you look at the mid cap, so what's the main takeaway from here is that the mid cap is a segment which is very much consistent, and it has given the most consistent return across the last 14-15 year time frame. In fact, if you look at the rolling return that the mid cap has given, it has outperformed all the other categories. And in fact, the volatility that's being given by the mid caps, it's lower than the Nifty and the small cap as well. So if you look at the risk adjusted return, the risk adjusted return is highest for this mid cap category. Now if you go back and look at the total performance that it has delivered since its inception in 2005, it has actually, the mid cap index has outperformed 90% of the mutual funds out there. So if a client is looking for a passive source of investment where he doesn't want to diversify and look for stable long-term returns, then mid-cap category actually outperforms 90% of the mutual funds out there. And in fact, it's such a dreaded category. Out of 350 or more than 350 PMS schemes, only 30 or less than 30 PMS schemes have this category as a benchmark. So we have identified this category because there are a lot of emerging winners which are coming from this segment, and we have tried to create a mid and small cap portfolio out of that. So we follow a process which is growth versus the value model. And in fact, if you look at the stock price driver, so there are two things that drive the stock price return. In the long term, the earnings drive the stock price, and in the short term, the multiple expansion and contraction drives the stock price. So if you combine and create a portfolio which can double the earnings every 3 to 4 years, we have something the portfolio stock price will always come up to the earnings and will be doubling in next 3 to 4 years. And if you create a portfolio where the multiple also has the possibility to re-rate in future and be 2x or let's say 1.5x, so it will give sufficient margin of safety to a portfolio, and also it will be again return driver to the portfolio. So let's just look at example how we have done it in the past from FY20 to 22. So these stocks are just for the educational purpose, and this may be or may not be in the part of the current portfolio. But if you look at some of the stocks that we are holding currently, so if you look at the consistency in all of these stocks was that the earnings has doubled in last 3 to 4 years. But if you look at the return from the multiple rating, and that was the main thing that was driving the returns on the stock price. If you look at the stock price return, it has been 4x to 6x because of the multiple rating the stock has gone through. So the question is, can we replicate the process again for the next cycle? Now if you look at the themes for the next 3 to 5 years, and we have these stocks from these segments in the portfolio today, where again we are targeting at least doubling the earnings over next 3 to 5 year time frame. And if you look at the multiples that these stocks are currently trading, the multiples are trading at a discount than the industry. So we are hopeful that we will be making again somewhere between 2x to 4x kind of return from the 20-25 stocks that we are holding. Now we have been running this portfolio for 3 years, and 3 years is a very less time frame to judge an equity scheme. But let's understand how we have done across different up cycles and down cycles. So if you try to break the last 3 years, we have seen multiple up cycles, like between the 1st November 20 to October 21, it was an up cycle. Then between October 21 to June 22, we have seen a lot of things happening in the market, right from Russia-Ukraine war to yield going up to 20 years high, inflation going up to 40 years high, and we have seen the market collapsing. And then again, we saw a shift in the market, and then we saw up cycle from June 22 to November 23. And across the time frame, we have outperformed the market by some some margin or so. So we have been able to consistently outperform the market across different time frame because we keep switching the stocks as per the market cycle. And if you look at the last 3 year returns that we have delivered, so the last 3 year returns has been 41% for the scheme as against the 20% the index has delivered. And in fact, this is the complete list of mid-cap schemes which are there on the PMS side. And we have been outperforming majority of the schemes, in fact all of the schemes in the category. And out of the 360 schemes, there are total on the PMS side, we are there in the top 10 in the last 3 years time frame. So now that we have created a core and satellite portfolio, so just look at the returns that we have delivered. So the all seasons portfolio will be the core portfolio and the SuperValue is the satellite portfolio. If we combine both the portfolios in a percent of, let's say 80% in the core and 20% in the satellite, so we have able to manage and outperform the Nifty return in a very consistent manner across all the time frames. So this is what we are trying to do. We have create a portfolio where retailers having an investable corpus of less than 2 CR can come and invest and participate in the wealth creation journey that's there. So just a quick info about the right horizons. So we have been in the business for more than 10 years now, and we have multiple schemes, more than 7 plus. Aside from the SuperValue and all seasons, we have 3 more equity schemes, 1 retirement savings scheme and 1 AI portfolio. So the investor has the complete freedom to choose between the schemes, even with a minimum ticket size of 50 lakhs, and allocate as per their preference. And we have been engaging deeply with the IFA community based out of Bangalore, Kolkata, Mumbai, and we are looking Delhi as well. And we are looking to engage with all of you and try to create a meaningful solution for the clients. Thank you.